They sold payday loans as a tiny emergency bridge. Just borrow a few $100s, pay it back in 2 weeks, small fee, problem solved. But when regulators finally studied 15 million real payday loans, they discovered something else entirely. The business was never built around people escaping debt. It was built around people who couldn't. Only 15% of borrowers repay on time without taking out another loan within 14 days. 4 out of 5 loans are re-borrowed within the month. The average borrower takes out 10 loans in a year. 75% of the entire industry's revenue comes from people who cannot get out. The payday lending industry spent years lobbying against one single regulatory requirement, that before lending someone money, you check whether they can pay it back. It fought this requirement not because it was impractical, but because the inability to repay is not a risk to the business model. It is the business model. That is why we call it the debt trap, and it was not a side effect. It was the product all along. To understand how this became legal and stayed legal, you need to understand the fee structure. A $15 interest on every $100 borrowed sounds reasonable. For a 2-week loan, it sounds modest. Annualized, the way every other financial product in the world is measured, it is 391% APR. The industry knew this arithmetic before regulators did. It successfully argued for years that APR was irrelevant for short-term products. When disclosure eventually became mandatory, the industry ensured it was buried in fine print after the loan was signed. In 2017, the Consumer Financial Protection Bureau finalized a rule requiring lenders to assess a borrower's ability to repay before issuing a loan. Not a complex assessment, a basic one. Instead, the industry lobbied. Then, in 2020, the provision was reversed. The official reason was that the rule would reduce the number of loans being issued, and that was exactly the problem for the industry, because the rollover is where the profitability lives. This is how it is engineered. A payday loan is due in full on your next payday. You receive your salary and you owe the full amount plus the fee. If you repay in full, you have less money than before the emergency you borrowed to address. If you cannot repay, which most borrowers cannot, you pay a rollover fee. The principal stays, the clock resets. 2 weeks later, the same arithmetic returns. About 1 in 4 payday loans does not end after the first repayment. The borrower takes out another loan, then another, sometimes 9 times or more. By the end, many people have paid more in fees than the amount they originally borrowed. An emergency loan that was supposed to solve a crisis often becomes the crisis itself. Now here is where I want to stop for a moment. Because if you've ever used a payday loan, or something that looks like one on your phone, you already know something the industry spends considerable money hoping you will not name. You know the loan did not solve the problem. You know the problem was still there 2 weeks later, plus the fee. This research is not about the choice you made. It is about the architecture of the system you made that choice inside. Before we go to the solutions, I want to name the industry's best argument honestly. Without payday lenders, where would these people go? They would bounce checks at $35 each. They would have utilities cut off. They would turn to informal lenders with no legal recourse. The argument has some merit for some borrowers in some circumstances. Here's what the evidence says when you test it at scale. Every state and country that has reformed payday lending has been asked this exact question. In every documented reform, as seen in Colorado, Ohio, Virginia, Canada, access to small dollar credit was maintained or increased after regulation. What changed was the cost. The industry's central argument was tested against real data in 4 U.S. states and a country of 38 million people. It was found to be wrong. Canada is the most thoroughly documented national intervention available. For years, Canadian provinces regulated independently. Each time a province lowered its rate cap, the industry predicted access would collapse. Each time, the data said otherwise. When British Columbia lowered its cap from $23 to $15 per hundred borrowed, loan volume increased. Consumer surplus, the measurable financial benefit to borrowers, grew by $28.6 million per year. The borrowers the industry said would be abandoned were not abandoned. They borrowed more at lower cost. In January 2025, Canada's federal government implemented a nationwide cap, the criminal rate of interest reduced to 35% APR. Payday lending was capped at $14 per hundred. The most significant national reform in the country's consumer credit history. The lesson from Canada is not simply that caps work, it is that the industry's predictions about what caps would produce were consistently and specifically wrong, and each province's data became the evidence base for the next reform. The United States produced something more instructive than a national reform. It produced an accidental controlled experiment. Because state law governs payday lending, different states operate under different rules. The same national lenders operate across all of them, charging whatever each state allows. Colorado reformed in 2010, replacing the lump sum 2-week payment with installment repayments spread over months. Borrowing $500 for 4 months in Colorado now costs approximately $110. In an unreformed state, the same loan from the same lender costs $600 or more. Ohio became known as one of the worst payday lending markets in America. So in 2018, the state changed the law. It banned the old single-payment payday loans and closed the loopholes lenders had used for years to avoid previous reforms. The result? Ohio families now save more than $75 million a year. And despite industry warnings, lenders did not disappear. In fact, after the reform, Ohio issued its first new lending license in 11 years. Virginia followed in 2020. Borrowers who previously paid $300 in fees to borrow $500 now pay $138. Same amount, same lenders, different law. 4 states, 4 different political compositions, one outcome. Lower cost, maintained access, the same lenders, profitable at lower margins. Rate caps reduce the cost of the trap. They do not by themselves build a door out of it. The credit union Payday alternative loan program is the most documented exit available. A $500 3-month loan through a federal credit union's PAL program costs no more than $44 in total, compared with an average of $450 from a Payday lender. The credit union reports positive payment history to credit bureaus. The Payday lender does not, meaning years of Payday borrowing build no credit history, leaving the borrower as invisible to the formal financial system on their last loan as on their first. The PAL program issued $227 million in loans in 2022, a record, 30% above the previous high. The demand is there, the product works, the constraint is scale and awareness. The mechanism did not stay in North America alone. A study of 68 unlicensed digital lending apps across Ghana, Nigeria, South Africa, and Kenya found the same architecture on a phone screen, undisclosed interest rates, rollover structures, and one new addition the American storefront never had, contact list access, used to message the borrower's family and colleagues when repayment was overdue. The debt trap in your pocket, with your relationships as collateral. Kenya's central bank has established frameworks for digital financial services. Ghana operates a regulatory sandbox for fintech. The tools for reform that worked in Ohio and British Columbia exist. The question is the same question every government is quietly answering right now. Whether the people most exposed to the trap are the constituency it is most motivated to protect. Zara has had a loan app on her phone for 2 years. Clean interface, friendly language, 30 seconds to approval. She has used it before, for a bill that arrived before her pay, for her daughter's school materials, for a repair she could not defer. Each time she repaid it. Each time the next 2 weeks were tighter than the 2 weeks before. This month the same situation arrived. The same app is open on her phone. She closes it. Because 2 episodes ago she joined a credit union. She looked up this week whether it offers emergency loans. It does. The process takes 3 days, not 30 seconds. She applies anyway, not because it is convenient, but because she has started understanding the difference between a product designed to keep her returning and one designed to help her leave. The confirmation arrives on the 3rd day. The rate is documented. The repayment schedule is fixed. There is no rollover option, not because anyone forgot to include one, but because the product was designed without one, on purpose. She reads it twice, not because she does not understand it, but because she wants to. The Payday loan was always presented as a bridge, something to carry you across a gap until you reached the other side. What the data shows, across 15 million loans, 4 U.S. states, a country of 38 million people, and 68 apps across 4 African countries, is that for most people who use it, the bridge does not end. The fee resets the clock. The gap stays. The bridge was the destination. There are governments that looked at this data and passed legislation. There are governments that looked at the same data and passed nothing. The difference between Ohio families saving $75 million a year and families in unreformed states losing that money is not economic conditions. It is not the sophistication of borrowers. It is a design, and that design is a law, a specific, named, dated, votable law that someone chose to pass or chose not to. You now know what the law that was passed looks like. You know what it produced. You know what your government has chosen. If this changed how you see that 30-second approval screen, share it with someone who needs to understand what they are approving. Subscribe so you are here when the next piece of the architecture gets named. The system does not explain itself. We do.